Hello and welcome. We're here today to discuss the findings of the Cutback Economy Report, which we have just released. I'm joined by a fantastic panel of guests to discuss the report. My name is Nicola Sartori. I'm a partner and head of consumer here at Grant Thornton. And I'm joined by Alan Dale, head of business consulting at Grant Thornton, Kevin Coates, head of London Restructuring at Grant Thornton, and Richard Lim, who's the CEO of Retail Economics, who's our partner in writing the report. And Richard, you're our partner in compiling the report, and you did that for us last year as well. So first off, I'm really keen to see what you perceive as the differences from the findings of last year's report to this year's.
It's been fascinating actually to be able to do a piece of research about consumer behaviour, how they're reacting to inflationary pressures and how they've cut back their spending across different areas, and actually be able to compare that from one year to the next. I think one of the most interesting findings is that the level of cutback has remained broadly similar to the levels that we saw last year, but it's the intensity of cutback that's actually changed. So we've seen people that have said that they're going to cut back deeper than the previous year, and also the composition of households has changed. So this is against a backdrop of rising interest rates, which is really putting housing affordability under pressure for lots of families. And actually what we've seen is that the middle income households are the ones that have seen kind of a shift away from people who are comfortably cautious or say that they are financially immune. And we've seen that kind of migration from some of those areas towards people that say, actually, we are going to cut back. And that migration has actually come with middle income households, which has been quite interesting.
Okay. And that clearly creates a lot of challenges for businesses. And Alan, coming to you, what can businesses do to stay one step ahead, sort of strategically and operationally, with such a challenging economic environment at the moment?
No, and it has been such a changing market, and there are winners and losers here. So the people who are doing really well through this, we probably see them playing with lots of things. We see them making sure they understand their market, making sure they understand their route to market. And it was very interesting to see in the report that the importance of retail and shop front as opposed to online, as people shop for the value. But then they look at cost base, because an awful lot has changed about their business, their people costs, the labour costs, the input costs, the energy costs. And against that backdrop of rising costs, that they've not always been able to pass on any of those cost increases through to consumers. And so what we're finding, those people who both win and who are in a little bit of distress, is they've taken the time to really understand what drives their costs and what levers they can and can't pull, both in the short term to survive, but actually those ones who are really winning are looking at what are the longer term actions that they can take around the ops model, which impacts the costs, which means that they can not just survive, but thrive.
Okay. Kevin, businesses are obviously facing significant challenges at the moment. How are you seeing what's happening in the market from your perspective?
Rather surprisingly, in terms of restructuring and businesses facing distress, we haven't actually seen a lot of that happening in the consumer space as much as you might think, especially based on the findings of the report. And that's probably driven by the savings that people have managed to build up over the course of the pandemic, and then coming out of the pandemic and want to enjoy their life once again and spending money. Having said that, what's happened recently is we've seen a slight tick up in the level of distress within businesses. And it's not necessarily sector specific, albeit we are seeing more distress towards the non-essential markets and those where product can be switched out for cheaper alternatives. What's actually driving distress at the moment really is a functional issue. It is balance sheets that have tended to be over-leveraged. People have built up a lot of debt over the course of the pandemic and now having to deal with that in a high interest rate environment. Secondly, it's about managing working capital with the focus at the moment on what the customer requires and not understanding what's happening in the future with inflation, that's proving somewhat of a challenge. So being laser focused in terms of your working capital and your stock profiling is a key difference to whether you make a profit or not. And I guess the third challenge is around forecasting. It's inherently difficult to forecast in a market where costs are increasing on a regular basis, interest rates are moving forward. You don't know what's going to happen from a cutback perspective in terms of your retailers. Is your product, does it have a good value in the market in terms of recognition? Are people prepared to pay for that? And that's proving somewhat difficult.
Okay. And actually just picking up on one of the key things which Kevin touched on there that's come out of the report is this shift from, well, I think we call it unified channels, so the shift from online back to stores. Richard, how do you see that playing out now over the next 12, 18 months? What does that look like?
I think the focus for consumers at the moment is on cost and value. And so they're making these trade-offs between different attributes when they're deciding who to shop with, what channel to shop across, and the types of products that they want to purchase. So they're making these constant trade-offs and in many ways sacrificing potential perceived quality for lower costs, or sacrificing an experience for lower costs, or even having a more inconvenient experience for lower costs. And what we've seen is that there has been this kind of shift back to store, and consumers are taking an active approach to try to limit their exposure to unnecessary costs. So when it comes to online, for example, people are choosing maybe to avoid delivery costs, avoiding returns costs. Their kind of cash flow is under so much pressure that they don't want to necessarily order something online and then have to wait for a refund. There's also, what we've also seen is an increased use of cash. So people are going to a cash point, withdrawing £100 for the week and using that as an active way to try to manage their budgets. And obviously that has an implication on the channel across which people shop. So we've seen this kind of shift back to store. And actually, when you look at the long run growth of online, we saw a huge kind of uptick caused by the pandemic, and we saw the huge shift towards online. And at that point, everyone was trying to figure out how sticky that shift towards online was going to be. Has online fast forwarded by 1 year, 2 years, 5 years, and everyone was trying to work that out. And actually, now the dust has settled on online, what we've seen is that the size of the online market is pretty much in line with long-run trends going up to 2019. And actually, if you kind of look at the long-run trends and look at where we would have expected online to have been had there not been a pandemic, we're pretty much aligned. So we saw the pandemic have a huge impact on the shift towards channel. There's a blip in online sales, and actually that blip was a £54 billion blip. But actually we've kind of got back to levels where we would have expected the size of the online channel to have been anyway.
And Kevin, with such shifts in the market, if businesses are now at the point where they're facing significant stress or distress, what options do they have, and what should they be doing?
I guess the first thing to think about, there's stressed and there's distressed. I think the earlier you address the problem, the better. It gives you more options available. I think early engagement with key stakeholders, particularly lenders and shareholders, who can help you address some of those issues from a structural or capital perspective, really important. Forecasting, as I said before, becomes really key in terms of seeing how much runway you've got to find those options and those solutions. Clearly, if you can find a consensual solution around any capital issues or liquidity issues, you need to be focusing on those at an early stage. However, if you get to the point where you're at that point of no return, your capital structure might have been fit for purpose historically, might not be fit for purpose in the future, and you can't get a consensual restructuring through. There are formal restructuring options available, and people may be aware of sort of CVAs and administrations that have been mentioned and used historically quite a lot within the retail and consumer space. More recently, we've got a new plan, I think called Restructuring plan, that's allowed far more flexibility in terms of what we can do in terms of restructuring a balance sheet, let's say, to allow a business to prosper in the future. And just a couple of key elements that come from that restructuring plan. It allows you to recut how your capital is set up. It allows you to cross-class cram down some of the stakeholders that are lending to the business without having ransom creditors hold out their position. So it gives you a far more flexibility to fix maybe a historical problem, so you're fit and ready to address the market in the future.
I think that's a key point, though, Kev, is that sometimes people leave it too late to engage their key stakeholders, be it banks or shareholders. Once it gets to that point, you're moving from stress into distress, and people feel they've got to take an option really quickly around that. The people who are succeeding and the finding their way through this engage early with the problem they see with their banks, say. They bring the banks along on the journey, give them the confidence about the market, the product, the business, the cost base, and what their plans are. And then when they get to that future plan for their business, the bank's been alongside them, as opposed to a to-dar which says this is the answer. So that early engagement, Kev, I agree, is really key.
Yeah, and if you're addressing it early, you can address some of the P&L based issues. So the cost cutting, the looking at non-core elements of the business. Can you take those away from how you trade and focus on the real value add before you actually get to the balance sheet structural issues?
Yeah.
So definitely, the earlier, as I said before, the earlier you start looking at the problem, the more options you have available. The other thing around sort of early engagement is not just about engagement with key stakeholders, but it's seeking professional advice and knowing what all of those options are as early as possible.
Yeah.
And as I said before, it's about being decisive and it's about being quick in those decisions. Because the quicker you make a decision, the more decisive you are, the more chance you have of pulling through any issues you might have.
Yeah. Thank you.
I'd agree with that. And also I think the pressure on profitability is probably one of the biggest challenges business is going to have over the next 12 to 18 months. If you look at, we did a piece of work, if you look at the top 150 retailers in the UK, pre-tax profit margins have pretty much halved in the last 10 years. And so we've had this wave of costs coming through, as mentioned earlier, coming through kind of logistics and utilities, labour costs continue to rise. And that's putting intense pressure on profitability, and that's against a backdrop of softer consumer demand as well. And so there's a real kind of a real pressure on profitability that we're going to see running through the next 12 to 18 months.
Just to add to that, Richard, in terms of profitability, clearly interest rates are on the rise. If you believe the markets, we're potentially going to 6.25% by the start of 2024, and then maybe that's sticking till the end of 2024. So costs are only going to increase. So focusing on other things like your working capital and stock is going to be key, because the more efficient and clean, how you can optimize your working capital is going to be really important, because for every pound worth of working capital you have set on your balance sheet, that's going to cost you a lot more with the increasing interest rates. The other thing about capital as well at the moment is it's proving more and more difficult to refinance. It's not just the current issues that we're seeing in terms of the financial costs on an ongoing basis, it's the ability to refinance. So the early engagement on refinancing is also important. Historically, we had high street lenders actively investing in the market. They're now pulling back slightly from the sector. So you're now looking at less traditional markets such as secondary lenders, direct lenders and credit funds, which are historically more expensive form of capital. And therefore understanding that at an early stage and being able to forecast the impact of that on your business is really important.
I mean, one of the key things that comes all the way through is the competition for that hard-earned consumer pound. And there are some areas within the report which do show consumers are prioritising. So travel is one of the key ones there, and also experiential leisure activities. And one of the things that struck me, and I've seen this with a number of our clients, is that when you go out, consumers do want to still go out and eat at a restaurant, but when they go, they want it to be value for money and a quality experience. In terms of areas, Richard, where you think the consumer will continue to prioritise spending, what's come out of the report, and how do you think that will play out for the next 12 months?
It's a great question. I think consumers it's an uneven picture across different households, depending on age, depending on affluence group, even some regional variations as well come into that. So whether consumers are adopting kind of recessionary behaviours of trading down or delaying purchases or cancelling purchases altogether, it's quite an uneven picture. But at a macro level, what we've seen is that parts of kind of leisure and hospitality have been hit hardest. So people are cancelling in terms of takeaways or going to restaurants. And some of those areas, but I agree that and there's different kind of ways to manage budgets, and people still want to go out. They still want to go to their favourite restaurants. They still want to have an experience. They just might not do it as frequently as they did before the cost of living crisis. So people will kind of prolong the replacement cycle of particular products. They might not go out as frequently as they used to. So there are some areas like that. In terms of ongoing pressure within the retail space, electricals is one of the kind of the verticals that were highlighted within the report. Is typically quite price sensitive. People will cut back their spending in those types of areas, or they might just prolong the replacement cycle of certain products. So electricals being one of those areas. More defensible food is an area that came out. Health and beauty is another area that was highlighted in the report. Of course, these are areas that are typically defensive during recessions. And pet care as well as another area.
And if you had to predict the next 12, 18 months, Richard, what do you think that looks like?
I think the next 12 months, 18 months is going to be difficult. I think what we're going to see is that the scope of households that come under pressure has gone from the least affluent households to a much wider cohort of households that include more affluent households because of the increase in mortgage repayments. But also what we've seen is that throughout the pandemic, households managed to save an incredible amount of money. Bank of England estimated it was about £200 billion, and people have been using those levels of savings to support their spending over the last 18 months or so. And so that kind of cushion is being eroded, and so we're not going to see that level of support continue over that time. But I do think we're going to have a polarised market where there are a significant group of households, in our report 12% of households that essentially are financially immune, kind of a bit of a keep calm, carry on, cost of living crisis doesn't really impact their spending behaviour. And that group of households disproportionately spend more. So that area of luxury spending is likely to hold up better than other areas. And then it's going to be the middle part of the market, in my view, that's going to kind of feel the hardest pinch as people trade down, look for cheaper alternatives. And so retailers, hospitality, leisure brands that sit in that middle part of the spectrum, I think is going to find quite a difficult time.
And so, Alan, Kevin, if there was one piece of advice that you would take from the report that you would give to businesses, what would that be?
I think whether firms are surviving or thriving through this, I think the one advice I'd give them, and those I see who are well set for the future is don't play at this and take out a little bit of cost. Because for an awful lot of the markets, for the products, for the people, for the customers, the whole market's changed. Those ones who will survive in 3 years' time and lay the foundation for a very successful future will really look at the markets they serve, their routes to market, the way they run their business, the cost base of that. And they will take this moment in time now to really understand that, to set the plans for the future. Those who tinker around the edges of that are going to find themselves under real stress and pressure.
Thank you. And Kevin?
Yeah, just to add to that, I think we're hearing that things are going to get tighter, they're going to get more difficult with interest rate rises. Core inflation is actually increasing despite overall inflation decreasing, so it isn't going to get easier. So the key takeaway for me is really understanding your business. Take the time now to understand what your value proposition is. Also focus heavily on your forecasting. Now is the time not to skimp on forecasting what's going to happen in the future. I appreciate it's really difficult given all the variables, so you need to throw more time at it to understand what's happening, because it gives you two things. One, it gives you time to fix any issues that might be coming. And secondly, it gives you visibility into the future in terms of the next steps you're going to make to fix the business or pivot, for want of a better description, to make sure you can react to the challenges that are coming ahead.
Fantastic. Thank you to our panel. The report is now available to view online, so please download that. And if you have any questions or would like to discuss any of the report's findings, please don't hesitate to get in contact.